5 C's of analyzing credit risks. Till now, we have covered the yield curve of bonds, which was quite an interesting topic. Today, we will talk about the 5 C's of credit analysis, which is one of the most crucial factors in knowing which company is worth investing in. But before anything, hey, this is Priyanshi and I welcome you all to our knowledge series by Smest Discover, where you can get smart about investing. Today, we'll be learning about the 5 C's of credit analysis. So let's get started. Credit analysis is the process of determining the ability of a company to pay timely coupon payments and repayment of debt on maturity. It includes both qualitative and quantitative factors. Debt obligations are mentioned in the bonds IM, which specifies the interest rate, frequency, and maturity date. The main focus of credit analysis is to understand the company's ability to generate cash flow over the tenure of its debt obligation. Bondholders who lend their money need to assess the chances of the company's defaulting and the loss severity if the company defaults. This is where the 5 C's of credit analysis come into the picture. It has predefined steps. Mostly, it is used to gauge creditworthiness. So to start with, first is capacity, collateral, covenants, character, claims priority. Let's discuss each one of them in detail. Capacity. Capacity is the debt servicing ability of the issuer. But the real question is how to determine the capacity of the issuer? To determine, following parameters of the issuers can be looked at. Number 1. Market forces like threat of any new entry in an industry will make an existing company to share profits with them. Bargaining power of suppliers and customers, rivalry and substitutes available may hinder the issuer's debt servicing capacity. Number 2. Industry fundamentals should be benchmarked and compared with the issuer. Number 3. Quantitative analysis plays a crucial role, which includes measuring various ratios with respect to the profitability, cash flows, leverage, and coverage ratios. Number 4, and the last one to run over, is company fundamentals, which include the standing of the company in the competition, to investigate the company's track record since inception, management strategy, and execution over the years. Collateral is the asset pledged against the debt, and assessing its quality is essential. It is important to look at the quality and value of the company's assets. However, it is a bit difficult to observe and understand directly. So, here's how to assess the quality of collateral. Firstly, the intangibles in the balance sheet give signals about the company's long-term viability. For instance, patents can be sold and can increase liquidity positions, and goodwill, on the other hand, can be written down, indicating weak quality. Number 2, the other way is to look at the equity market cap, whose stocks trade below book value indicates low quality assets. Number 3, the important asset of any company is its intellectual capital, which is the running wheel in generating the company's cash flows. It becomes more important to look at the management decisions in the past to project the future efforts. Third one, covenants. Covenants are meant to protect creditors while also giving management sufficient flexibility to operate its business on behalf of the shareholders. And here's how you can assess covenants. Number 1, the obligations, which include making timely interest payments, principal repayments, filing audits, paying taxes on time, etc., are the affirmative covenants that the issuers are obliged to do. Number 2, the clauses which limit the issuer to perform some activities are called restrictive covenants, like maintaining a certain amount of ratio levels, capping the dividends, redeeming the debt of a certain event occurs, etc. But since covenant language is very technical and written in legalese, it can be helpful to have a person with legal background to review and interpret the specific covenant terms and wordings. Fourth one is character. Character simply refers to the quality of management. The character of an issuer is assessed in the following ways. Number 1, an assessment of the soundness of management strategy. Number 2, management's track record in executing past strategies, particularly if led to bankruptcy or restructuring. Number 3, use of aggressive accounting policies or tax strategies like off-balance sheet liabilities, capitalizing expenses, or frequently changing auditors gives a red flag. Any history of fraud or malfeasance of the company, managers, or directors indicates a major warning flag. Previous treatment of bondholders, for example, management actions that resulted in credit rating downgrades, large dividends to shareholders, and debt financed programs give important insight to the management's quality. Fifth one, claims priority. This simply refers to the priority of repayment of principal, with the most senior and highest ranking debt having the first claim on cash flows and assets of the issuer. Now, how are these rankings done? Broadly, there are secured and unsecured debt. Secured debt means the investor has the direct claim on the asset and cash flows of the issuer. And unsecured bondholders have a general claim of an issuer's assets and cash flows. In the event of default, unsecured bonds rank below the secured ones under the priority of claims. Senior secured, senior unsecured, and then junior or subordinate is the simple flow of ranking. I hope today's video did bring you a step closer to being smart about investing. We hope you are excited to start your investment journey. Visit smest.in and take the next step towards investing wisely. Stay tuned for more exciting lessons coming your way. But before signing off, always remember, investments in debt securities are subject to market risks. Read all the offer related documents carefully. For any queries on this module, please leave a comment below. See you in the next video.